Hello class, welcome back to B grade economics. I'm your class leader Nate. Let's get started. So today we're going to be talking about leverage. We're going to define leverage and find what kind of leverage is available and what are the risks that are inherent with those types of leverage. We'll show you how to properly assess what kind of leverage you have and then understand the consequences of that leverage. So first off, we'll talk about buying spot. Spot is purchasing something at its asking price for the specific underlying asset. Leverage is the ability to maximize the growth in that asset, that underlying asset. It's taking out a form of debt or borrowing or making a promise based upon that asset. So it gets you more opportunity, but also it comes with other types of more risk, and you just need to familiarize yourself with what kind of risk those are. So everybody's probably heard the term margin, buying stocks on margin. It's been a meme, it's been a cultural phenomenon to mock or ridicule the concepts of using margin. And the reason why is mainly because margin was a predominant reason for the 1929 stock market crash during high speculation. People borrow money against the assets they already hold to buy more of the asset, but the problem is that they run a risk of being margin called. Margin calling is when you get asked to pay the debt that you've taken out, the margin, on the assets that you hold because the assets have gone down or the amount that you've borrowed has exceeded your capacity to handle it after the interest rate is applied. So you have to watch out for being margin called because it can cause you to sell assets instead of making money from them. As we saw in 1929, there were bank runs because of margin calls, because of the drop in asset prices, and banks didn't have the money on hand because they were leveraged. We also saw margin calls recently with several major retail or major investors putting option calls in at a point where once they failed, even though the bet was great, people were willing to follow the group mindset. And when I say people, I mean corporations and banks were willing to follow the group mindset that someone was correct on a piece of information and therefore they were going to continue to make money. The idea that stocks only go up drives that mindset to go over and beyond your leverage safety. So the other type of leverage is a loan. Margin is effectively a loan, but we can also talk about cash loans. There's secured and unsecured loans. Secured loans are borrowed money against an existing asset. Margin would be a type of that secured loan, but you could also take refinance your home, or just financing your home in the first place is a secured loan. A loan for your car or against your car is a secured loan. Using cryptocurrency and putting it into an account that allows you to take money against it is another secured loan against an asset. Obviously, the volatility of the underlying asset is the risk here. Unsecured loans is a loan backed by the credit and agreement of the bank. So if your credit is good, then you can take out a larger unsecured loan, and the only thing it's secured against is the promise or history of you paying the bank. So the other type of leverage that sometimes people talk about that isn't exactly the same kind of borrowed leverage are multipliers, ways to leverage an opportunity. There's different types in here. Revenue leverage is when the stock will grow in value due to increased revenue from an asset on their balance sheet. The example I would normally provide would be a mining company. If the price of the thing that they mine goes up, then the mining company's revenue and balance sheet goes up drastically, which causes the stock to increase much faster than the underlying asset that they're making revenue off of because their profitability increases by every single percent that the underlying asset goes above the cost of production. Speculative leverage is when an asset grows in response to the growth in a correlated asset. So when you take a speculation that if this is going up, then this will also go up, and it may go up even more, or it may have less volatility than the other thing, but continue on its way up. So there are ways to take speculative leverage where you just make a counter trade or a correlated trade as well. And then there are derivatives. Derivatives are a massive multi-trillion-dollar market, and they are contracts that offer the ability to lock in price and are priced in correlation to the price moves of the contracted asset. We have a little bit of familiarity with options as our first trade in our 1,000 to a million is an options trade. The benefit to most of these derivatives is that you can only go to zero. You usually, in most cases of these derivatives, can't go below zero, unlike a loan where you can be in debt. These will only go down until they fail. There are other types of derivatives that can send you to zero, but for futures and for options, you can only go down to where you can no longer pay the contract. So here's an example of correlated trades. We have silver and gold compared, and you can see how silver has gone up higher percentage than gold since the dip last year. However, if you look over the long trend, gold started the move. So if you had been in gold for the past 3 years, you would have made some good money over the amount that you would have made in silver. But if you were in silver the last year, you would have made more than you did in gold. It's responding in correlation to the movement in gold and then boosting its price much more. So again, we go back to that trade-off of when do I go into gold, when do I go into silver? And the time to be going into silver was in the past year. And then going into gold was several years before that. And then here we have in cryptocurrencies the same concept. Bitcoin tends to be the core leader in orange here, and you see that the price. We all know that Bitcoin has gone up. Everybody has heard the concept that Bitcoin is moving at this point. Whether or not you know the actual price or the actual results of it, you have heard that Bitcoin has been going up because it's been in the media. But you've also probably heard that Dogecoin has been going up because it's a meme coin. Well, it's a correlated asset. So when Bitcoin starts to move, you can see that the price of Dogecoin was relatively flat all through the bear market. There were pips. There's actually a little tiny spot in July 2020 when a TikToker pumped the price for a little bit and then it came back down. But because of Bitcoin's move, it stirs the speculative pot and people are going further out on the end of the risk curve to get more reward. And it works out sometimes. In Dogecoin's case, it's the speculative mania that is driven from Bitcoin's beginning moves. So there may be an underlying asset that's less volatile, but it has promise, and therefore the other speculative assets have a comparative advantage against that asset for their growth. And then when we get to the derivatives risks and gains, this is an example using the NASDAQ again, QQQ ETF. This is an options call that just shows you the different trend lines, and you can see the little black line going horizontal near the dashed line. That is the actual price of the stock, or that is where the black line going vertical is the line of the stock. And so even if the price of the stock goes up by 1%, it drastically increases the percentage of increase that you can make on the option, but at the same time, if it decreases by 1%, it drastically causes higher losses. And so just a comparison for the risk of using the types of leverage available, there's you can do spot, like example, buying spot gold with income is a comparatively low risk because it's relatively low volatility, and so therefore you're relatively protected in terms of its overall moves. You can't lose more money than you put in, and it probably will only go up and down a certain amount because it has a long history of performance and doesn't show signs of having a complete loss of function. Meanwhile, on the other end of it, you can compound all three types of leverage by buying out of the money call options, out of the money being really high. We'll explain more when we get into call options in a later video. On a junior silver miner, meaning a small miner that has not produced very much or has only found a mine to get started with and hasn't become profitable yet, with margin and loans, that's an extremely high compounding leverage risk. And so the comparison here would be jumping on a bed versus jumping out of an airplane without a parachute and a net is the only thing that catch you. It's not to say that you can't do it, but the area for success is much thinner and therefore much less likely to go well for you without massively excellent calculations and a lot of luck on your side. And so that'll complete a basic introduction to leverage. We'll move on to introducing the valuation of a company and how you can identify whether or not a company is overvalued, undervalued, and how to make comparisons between other corporations as well. And then we'll move into options so that this way we can all understand be on the same page about what an option is and how it works. Again, we just have to wait to close the final trade on Monday for our options call on the NASDAQ. We'll see if it's gone up or down. We'll see if we actually are able to sell or if we're going to still hold through that. but it looks like we are going to meet our target. I didn't update this, but follow me on Kobe.io to see how I actively manage a portfolio. Thanks for watching. See you next time.